Trading foreign exchange on margin carries a high level of risk and may not be suitable for all investors. The high degree of leverage can work against you. And before deciding to invest in foreign exchange, you should carefully consider your investment objectives, level of experience, and risk appetite. The possibility exists that you could sustain a loss of some or all of your initial investment, and therefore you should not invest money that you cannot afford to lose. You should be aware of all the risks associated with foreign exchange trading and seek advice from an independent financial advisor if you have any doubts. Welcome, Pivoteers. This is part 2 of our discussion of guidelines for model testing. It's a conversation which should help you create a template for testing whether or not a trading methodology works. In part 1, we discussed some common pitfalls that come from testing, some common mistakes to avoid, and some problems associated with the time periods and the methodologies that sometimes we choose when testing. And today, I want to talk together with Kenrick about ratios and measurements that go into the process of testing. The article that Kenrick wrote is absolutely brilliant. Once again, it is available on the right side of the page in Campfire now. I am not the author of this document, and Kenrick truly is a super helpful individual for sharing this information with everyone. And dare I say that most of the time we avoid these types of conversations because they are seemingly heavy on the math or on the boring stuff. But the more I read this, the more excited I become about everything in general. I'm glad to have Kenrick here today, and if it's all right with Kenrick, what we'll do again today is I'll discuss the major points of the document in the webinar and then invite Kenrick to comment on each section or to simply let me know when he'd like to make a comment about it, because he is the author of it. And of course, it might even be better someday if Kenrick is the one that did the webinar himself. I'll do the best job I can of summarizing what we've got here. The Sharpe ratio is a number or a measurement that can be produced from the testing that you do in your holdout period. I guess you could also apply it to your sample, out of sample period, and you could also apply it to your live or demo trading period of time as well. And it's a risk measure attributed to the Nobel Prize laureate, Bill Sharpe, and it's just a simple way of quantifying our risk to reward ratio. We say risk reward, which is the wrong way around, but the Sharpe ratio is no more than the return. It's an annualized return divided by the risk measure, the annualized standard deviation. Therefore, a Sharpe ratio of 2 indicates that for 2 units of return are available for each unit of risk. And you can probably already visualize substituting your own measures of risk and reward to come up with your own ratios, and that's perfectly fine. Without getting into a historical debate, before the Sharpe ratio, there were other similar measures of risk to reward that were in use. We're just scratching the surface here, as Kenrick would probably agree, but the Sharpe ratio is a very popular and reasonably simple measurement that is useful. To put it in context, says Kenrick, the long-term Sharpe ratio for the U.S. stock market is about 1, based on a return of 15% per year and a risk of 15%. These numbers are debatable, partly because he wasn't specific about what time frame and not the object of the discussion. While on the other hand of the spectrum, one could consider Treasury bills, United States government bonds, that are yielding 0.5% per year, but with zero risk, meaning the risk of them going to zero or losing their value is theoretically zero. It's another debate, as the Euro crisis shows, but that's not the debate we're having here. Giving a Sharpe ratio of infinity. The point is that a high Sharpe ratio is not an end in itself and needs to be qualified like most things in life. Should one choose a Sharpe ratio of infinity versus a 1 without further qualifications? Well, of course not. On the other hand, if we had 2 similar strategies, we could legitimately choose a strategy with a Sharpe ratio of 2.7 over 1 with 2.5. Let me state this again. Let's say that your trading methodology seems to produce an annualized return of 20%. And so that's the number that you're thinking that it could return. And it has a risk of losing 20%, and that's a standard deviation. It's not just the biggest loss that it took, it's the standard deviation of the losses. So the average annual loss plus a standard deviation. If I've got any of that wrong, Kenrick can correct me. If it has a 20% possible annualized return and a 20% risk, a risk of losing 20%, that's a Sharpe ratio of 1. The reason that Treasury bills had a Sharpe ratio of infinity is that no matter what they return annually, they are thought to have a zero risk, meaning it's going to be fully paid back and your principal will be returned to you with that interest. Measuring, including for inflation, maybe it's not so great, but that's what the Sharpe ratio of Treasury bills is. Kenrick, anything that you'd like to submit here or add to the discussion? All right, I'm going to proceed here. Another related measure, which will be covered later, is the information ratio, which is the Sharpe ratio relative to an agreed benchmark. Imagine for a moment that you choose to explain your results as excess returns and relative to the U.S. stock market. Let's say that you're a currency trader and you're proposing that you should be entrusted with some money to manage, and the people that you are talking to say that they're already invested in the U.S. stock market. Well, what you'd want to know is how much better, theoretically, is your trading than the U.S. stock market. And in this case, the information ratio is the return in excess of the U.S. stock market divided by the variation of the returns. As an aside, if you're considering our model returns in absolute terms, then you can use the Sharpe ratio and information ratio terms interchangeably, and this qualification will become important in future work. What Kenrick's saying here, and what I agree with, is that it's important to understand at least one measure here. And that measure would be, what's your annualized return compared with your possible risk? And what most people do is they look at a trading system and they say, wow, that makes 50% per year. But they don't really talk too much about the fact that it can lose 70% per year. And that's a negative Sharpe ratio. That's an unacceptable Sharpe ratio, because you could theoretically in every year lose more than you risk. And you don't want to necessarily trade a methodology that carries with it the risk of losing more than it ever really has a chance of gaining on an optimal or ideal year of working. That's a measurement that I think is important to talk about. Another measurement is, how much better are you at trading than the Standard & Poor's index, the S&P index, is at returning money? Because if you're not better than the S&P at returning money in exchange for a certain amount of risk, then it doesn't really make sense to do your own trading and not just put your money in an index fund. Hard truth, but it's what an investor would say if they were going to put money in with you. At any time, Kenrick, happy to include your thoughts as well, and we'll talk about drawdown and then maybe turn a moment over to you as well. Drawdown gives us a worst case scenario idea of how large a loss can be from a peak to a trough on an equity curve. In plain English, it's the worst loss that can occur within a series of returns without regard to the start and end points. And this statistic gives some estimate of the worst possible loss if we are to begin trading the model at the peak, or the high point of our trading balance, to the trough, where positive returns begin to reverse the losses. Imagine for a moment that you see a drawdown number in your testing results. The reason that you want to look at that number is it's perfectly possible that the moment you begin live trading your system, you will begin to experience the drawdown. And as the laws of retail FX trading go, you're probably likely to experience that situation. It's worth restating that this measure is not period specific. It's not weekly, monthly, or annually, and it attempts to overlook period specific returns that can average out losses. Meaning, what you want to consider when looking at the drawdown is, over the entire holdout period, even if that's 3 years, what was your worst drawdown? And then make the assumption or pose the question, what if that drawdown occurs immediately when I begin to trade? Does it wipe away my entire account? Think about it for a moment. The statistic is very useful and important for a retail FX trader operating in a leveraged situation, where this number could be as high as 15% to 20% in some strategies. This is even when you're not breaking rules. I think that ought to be bolded. That sentence ought to be in bold, Kenrick. Kenrick, do you have anything that you'd like to say here? I'm going to unmute your microphone. To put this in context, in the institutional investor world, a money manager may be instructed that an investor can only tolerate a maximum loss of 5%. Remember, a drawdown of 5% could still occur, even in situations where the annualized standard deviation might be a lot less. Let's not right now get into the statistical reason for this, but we'll explore the concept later. Typically, when losses are approaching a maximum loss instruction from the investor, the manager will cease live trading, and they'll either A, do nothing until time elapses, which makes the experienced loss more palatable. For example, you may have a drawdown over 5 days of 5%, but if you do nothing for the next month, then a 5% drawdown is more palatable to the average investor, although the drawdown statistic has not changed. Or B, stop trading and continue to paper trade until the drawdown is either reduced or erased. In either approach, there's no specific or perfect solution to issue, and the only good outcome is if the manager continues to lose money with strategy. There is some satisfaction that further losses have been averted. However, the resumption of trading at any time in the future is no guarantee that returns will remain positive. In our model comparison, we should try to understand why the drawdown numbers are radically different in models that have not had a large change in parameters, such as stop loss levels. In addition, we might be willing to sacrifice some return to overcome the psychological pain of experiencing not only a high drawdown, but a model that experiences regular drawdowns. One way of identifying these regular drawdowns is to simply look at the rolling returns for a variety of time periods for your model. For example, you may have a model that regularly provides 20% annual returns over time. But when we look at the rolling 1-month returns, we notice many instances when it can be as high as negative 10% in a drawdown. We might also use this as a discriminator when choosing our models. It's also worth noting that regular high drawdowns will also be captured within the standard deviation statistic. It's important also to make sure that you understand that none of these models or ratios or measurements mean anything if you load your holdout period with poor data, or make poor assumptions about the spread, or make mistakes with regard to the assumptions about liquidity, volume, market being open, Sunday trading, and so forth. If you start with bad data and you end up with conclusions about drawdowns, they are absolutely insignificant and don't matter. We talked about it a little bit yesterday, but I don't think we really fully explored the concept as far as we could, that none of these measurements are going to matter unless you can show that the parameters that you have chosen for your holdout period, for example, don't just quote unquote work in one platform, but they work on a variety of platforms with, and we did mention this yesterday, with some leeway on what the exact parameters are. It's important to have a robust enough system that it can withstand some of those things. And when you look at the Hector pivot bias as a strategy example, you have Michael running a Python script, grabbing data from the cloud and producing returns. And then you have a strategy advisor inside of FXCM's strategy trader. You have a JForex script in Dukas copy, and a variety of other platforms that are running the model and maybe have slightly different data problems or slightly different spread problems. And what you want to get is you want to get to the point where your returns and your drawdown numbers are reasonably similar across a universe of tested environments, to make sure that you're not making an assumption that the drawdown is X based on faulty assumptions in the very first place. Let's see what comments or questions have come through. There have been none. That's no problem. The MAR ratio, I guess I'm going to call this the MAR ratio. This was new for me, and I want to talk about it next. Kenrick can elaborate upon this in a moment. The MAR ratio is a good way of standardizing the drawdown measure. It is the annualized return divided by the maximum drawdown. So you take the annualized return that the system might produce divided by the maximum drawdown. What that's going to show you is how badly does the maximum drawdown affect your annualized return. If you experienced your maximum drawdown near the end of the year in a fairly good year that's on average, does that drawdown destroy your annualized return? And it comes as no surprise that a high return strategy typically has higher drawdowns. The more money you're trying to make from a trading system, you're probably taking bigger trade sizes, and the more money you stand to lose if things go wrong. We have to decide if we're willing to accept a higher drawdown as the price for higher returns. To put things in context, everyone hears about stellar returns of hedge funds, but a drawdown of 30% or so is not uncommon for many of the high performers. In fact, MAR or MAR ratio of 1-2 is standard within the hedge fund management industry, while numbers in the region of 0.3 to 0.5 are normal within the traditional asset classes like mutual funds and so forth. As with other measures discussed above, we use the MAR ratio as a means of comparing our models. So if you put the Hector pivot system side by side with the standard Wallaby, side by side with MCC trading, side by side with, let's say, Kevin's methodology for trading longer term Wallaby trades, you would compare those given these measurements. And you would start with good data, and you would perform the analysis in a rigorous manner, and you would try to build robust methodologies and whatnot. You'd come away with those 4 methodologies, perhaps, and then you would compare the drawdown, the Sharpe ratio, the MAR ratio across the board, and you would say, given these numbers, here's what I think I should trade. Most people just change back and forth between trading systems without regard to any of these measurements, and simply with regard to a possible return that they have seen produced over a very short period of time. And those are the measurements that we want to focus on. In the next segment of this whole process of talking about risk and modeling and whatnot, we'll talk about the risk management process, but that's coming next. I'll turn the time over to Kenrick for a moment. Kenrick, what do you have that maybe you could add to this discussion of ratios or whatnot? Thanks, Kenrick. Kenrick mentions that there are other measurements available, and also mentions that for those of you that are experienced users of Forex Tester, oftentimes we focus on the return produced from a time period in which we traded, and we don't focus enough on some of those other measurements. And today's presentation has given you an idea of what some of those other measurements mean and how they might be useful. I want to bring it all together in conclusion for today's webinar, and then tomorrow we'll wrap it all up in part 3. I want to bring this all together and bring us back to why we're talking about these things right now. Here's the reason that we're talking about these things. My goal is to professionalize the trading that you do. And what I mean by that is turn trading into a career rather than a hobby and have a structured approach to doing it. Most of the time when someone approaches a trading methodology, they focus on the return. We've said this many, many times. But there are ways to compare different trading models to one another, and there are ways to make sure that you're not simply grabbing a holdout period, creating parameters from a holdout period, and then declaring that your testing is done. That's the model that is usually used when people even agree to do any testing whatsoever. That's the entire model. But most of the time, people don't even agree to do any testing at all. And my challenge to you as you complete testing, and especially for those of you who are looking at December 31st as a deadline by which you will create a trading model that you will use. I think of those of you in that camp, and I realize that you have an opportunity in front of you that is exceptional. You have an opportunity to do some testing over the course of the next 2 months, and then compare the testing using these ratios to one another. You could start to compare the MAR ratio and the Sharpe ratio and the drawdowns to one another in a variety of different methodologies that you test. And let's say, for instance, right now in your testing, you're really seeking after the big win. You're trying to find a way to get the big win. You realize now that getting the big win also could expose you to the big drawdown. It doesn't necessarily mean that your trading system will be better. And approaching trading from the standpoint of, I'm trying to get the big win, doesn't really tell the full story. Trading and testing from the perspective that I want to manage risk conservatively is perhaps the better objective. You could also phrase that and say, my goal as a trader is to stabilize my returns. To start trading from the standpoint that I know that whatever bad things happen, in theory, the probabilities are that I won't ruin my trading account or experience a massive drawdown. And stabilizing the returns is part of the process of growing up as a trader. It's part of the process of understanding that you're ready to trade. Also, for those of you that perhaps are in a position where you're trading small lot sizes, or you are reluctant to trade at all because you really haven't found something that works, or that you are skeptical of your model. Oftentimes the question is, well, how do I know when my trading model is ready to take on full risk? And I advise you to consider the model presentation that we've been talking about here. Get a good set of data. Test that data in a holdout period. Take an out of sample period and then test the data again. And then demo trade it and determine whether or not that model is successfully demo trading in a way that would say, well, my model works. The problem is most of the time we're not willing to do that kind of testing. If you do that kind of testing and then you compare it with another trading strategy and then you compare that with the, for example, US stock market, and you have Sharpe ratios and maximum drawdown ideas, it's time for you to implement your trading model. There isn't, in my mind, some other way to become confident in the trading that you do. I think that this is a model guideline for accomplishing that. So right now, if you're testing with very, very small lot sizes and don't feel confident, this is part of the process that you should go through in order to become confident. I look back on testing that Tina and Kelly did on red zone euro-yen trades over a 17-month holdout period. They tested red zone trades on the euro-yen. What they could do now is take an out of sample period, meaning take a 3 to 6 month period of time from a different set of data on the euro-yen and compare the results they get from that with the original testing that they did on that holdout period. And then they could demo trade to make sure that in the live market, they're able to produce trades that look similar to that. Right now, what Hector is doing in his demo account, you can read about it on the personal watch list from week to week. You can see that Hector is demo trading or demo testing the Hector pivot bias trade in a live account, not only manually, but also trying to run it on an expert advisor so it completes automatically. He's trying to see if the results that he gets are similar to the holdout period and the out of sample periods that he's tested. It's pretty interesting, isn't it? And once he completes that process, shouldn't it be ready? Well, tomorrow's webinar, we'll talk about bringing it all together, structuring it, and then moving on. I think everyone inside of this group is at a different stage in that process. If I used Dan as an example, I would say that Dan has done testing in a holdout period, and then Dan has done an out of sample period by his initial standard wallaby trading that he did. And Dan's now going down the road of understanding what he's good at, and he's implementing it. And Dan has a full idea of the risk that he's taking. He has a full understanding that he's taking a certain amount of risk, and then he knows a certain number of things might go wrong. And Dan understands the parameters. There aren't a lot of reasons why Dan shouldn't be trading live. There aren't a lot. He's kind of made his way through that process. For those of you thinking about the Hector pivot bias trade or the standard wallaby trade, or Kevin comes to mind, testing and experimenting with some methodologies using the wallaby. It's time to sort of professionalize that trading that you're doing and come up with an idea of what these numbers are, these maximum drawdowns, these annualized returns, and then produce a plan based on what you've discovered. It's time to do that, and then stick with your plan and not switch around a whole bunch. Today, I was looking up a quote, and I want to read from it. It's from the book Wherever You Go, There You Are by John Kabat-Zinn. And the quote states, "So if you think your meditation practice is dull, or let's just say your trading system is dull or no good, or that the conditions aren't right when you find yourself, and you think that if only you were in a cave in the Himalayas, or in an Asian monastery, or you were riding your profits for 400 more pips, or you eliminated all of the losses on Sundays, or you were on a beach on the tropics, or you could use the average true range, or at a retreat in some natural setting, that things would be better, your meditation would be stronger, well, think again. When you go to your cave or your beach or your retreat, there you would be, with the same mind, the same body, the very same breath that you already have here. If you change your system or you alter it or you start playing around with endless tinkering, you're still going to be at the controls. After 15 minutes or so in the cave, you might get lonely or want more light, or now you want to use the Bollinger Bands, or then the roof might start dripping water on you. And if you were on the beach, it might be raining or cold. If you were on a retreat, you might not like the teachers or the food or your room. There's always something to dislike. So why not let go and admit that you might as well be home wherever you are? I see traders all the time say, yeah, that system would actually work, but it doesn't work for me because I don't like that currency pair, or I don't trust that currency pair. Or, yeah, that system could work for me, but I don't really want to run that methodology on Sundays, and it has to trade on Sundays. Or some people say, I've got the system down, but it's not good enough for me yet. I need to change some things. Well, why do we need to change some things? Why not let go and admit that you might as well be home wherever you are? We started off talking at the beginning of this course about the standard wallaby, and all along a version of the standard wallaby has been trading automatically on someone's account, and it's been running just fine. Dan knew all along that trading some version of the standard wallaby all along was working all right. But Dan kind of went off track, and so did Connie, and so did others. And then came back around full circle and said, why not let go and admit that you might as well be at home wherever you are right now? And right in that moment, you touch the core of your trading self. And when you understand that, things become perhaps a little bit easier. When you do your testing and you understand your drawdown and you understand your Sharpe ratio and you understand what works well for you, you have to grow up a little bit and say, maybe this trading system requires me to stay up late. Or maybe this trading system requires me to automate the methodology because I can't be there all the time. Or maybe the trading system that I'm working with right now is making money, and I should probably just be satisfied with that and make the money from the trading system and let go. A lot of us want to improve, and there's nothing wrong with improvement. There's nothing wrong at all. Actually, I respect it and I want to do it. But while you're improving the trading system that you're working on, don't forget that the trading system that you're working on had a standard set return already, and it required you to be objective in your thinking and implement it fairly specifically. Why not let go and let that be your research and development budget? Why not let go and let that system produce the returns that you already expect, and then move on to improvement? If you don't have a system that gives you a certain edge or certain probability of success, then the invitation is a little bit different. It's an invitation to let go and spend 2 months or a month of time determining what it is that you're going to focus on. I see Dave H. doing that, and I think that's magnificent. I see Hector doing that, and I see Michael and Kenrick doing that as well, to find what's really going to work, and long-term what you're going to be comfortable with, and long-term what you can agree to do without a lot of switching around and without a lot of alteration, to find a home and then just stick there. And that's our presentation for today. We'll be back tomorrow and we'll bring it all together. Thanks, Kenrick. Appreciate your participation. We're very grateful for the document that you've written and the time that it took you to do that.